everyone. Whether this is your first time or you're joining us again, thank you very much for participating in this educational webinar brought to you by Advanta IRA. Our topic today is using technology to build a balanced real estate portfolio. My name is Corey Daharsh, and our guest speaker today is Badri Malynur. Again, Corey Daharsh with Advanta IRA. I've been on the team with Advanta since 2016. I've spent a number of years as a client account manager handling day-to-day transactions. And in 2020, I transitioned to the business development team, where I provide a lot of education and networking just to pass along the knowledge of self-directed investing that I've built to hopefully help you build your own retirement portfolio as best as you can with your goals and interests aligned. Badri Malynur is the co-founder and VP of Investor Relations over at Avestor. He's been working with us for a number of years, providing some other educational content in the past, and I'm very happy to have him on today to cover a little bit about what they do over at Avestor and some of the opportunities that they provide to investment providers and investors alike. Badri, thank you so much for joining me today. I very much look forward to the information you're going to bring to our audience.
Hey, thank you, Corey. Very excited to be here, as always.
Awesome. Well, just for the audience's sake, I want to let everyone know I'm going to cover some basic information about Advanta IRA and our process, and then I'm going to hand over to Badri, who's going to cover his portion of the presentation, the real meat and potatoes of today's topic. As we get started, I want to let you all know that you're going to be muted for the duration of the webinar, but we do want your participation. So if you notice the GoToWebinar panel you probably have on your screen, there's a box there labeled questions. Please use that to add any questions you have about the presentation. I will go ahead and interject Badri's presentation if they relate to his slides or his information he's covering, and anything that doesn't necessarily relate in the moment, we'll be sure to also address at the end of the presentation. So we do ask for your participation. If you have a question, go ahead and ask it in that question box, and we'll address those accordingly throughout. Now, just to jump into who Advanta are and what we do, we are a self-directed retirement account administrator that's been in the industry for about 20 years. We've got just over 10,000 active clients and just over $2 billion in assets under management. All of our clients' funds that are not invested are insured up to FDIC limits, and each client we have is paired with a dedicated client account manager. So you as a client with Advanta have a one-to-one relationship. You don't have to worry about reaching out to a different person each time you want to do something with your retirement account or check on a rule or regulation. You get partnered with one person that's your go-to contact, and that's one of the things above and beyond these free educational webinars and podcasts that we put out that we try to do to stand above and beyond other competitors in our space. A brief disclaimer, today's content is strictly for educational purposes. Advanta does not provide any tax, legal, or financial advice, and everything you're going to hear today, again, is for education. We always implore you to do your own due diligence, consult your own CPAs, tax preparers, financial advisors before you enter any specific investment or investment type opportunity. If you have not heard of self-directed investing, that's actually very common, and it's pretty much the case that when you're with a larger custodian that serves as a fiduciary to you, they have a vested interest in you keeping your funds with them so that they're providing financial guidance and they're able to charge you for the services rendered or the financial advising they're doing. A company like Advanta that does not provide any fiduciary guidance is a lesser known option, but has been available for just as long as these IRA accounts have. And just for perspective, only about 4% of US-based retirement dollars are currently being utilized for self-directed accounts. So we do a lot of education, like I mentioned, to try to bring awareness and bring the possibility to your attention that you can put your money into these types of assets that you have more comfortability with, more understanding of, or just a better knowledge base so you know you can drive higher returns than those stocks, bonds, and mutual funds that you're often pointed in the direction of by your fiduciaries. There's a lot of different types of plans that can be self-directed. You're probably most familiar with your traditional and Roth IRA accounts, but if you're a small business owner with little or no W-2 wage earners, we also offer SEP, that's SEP, and simple SIMPLE IRAs, solo 401k plans, and then health savings and education savings accounts as well can be self-directed into alternative investments. If any of these plan types are interesting to you, feel free to reach out and I can provide you some more information or answer any questions you have relative to your interests and what types of plans you'd be moving from into a self-directed account. Just in general, it's a non-taxable event when you move funds from a previous plan to a self-directed plan, so you shouldn't have to worry about any tax consequence or any other really delays on funding or things like that. Most of these accounts are set up, funded, and ready to invest within about a week to 2 weeks. Why do people choose to start self-directing? Well, they finally hear about it and decide that, hey, I want to take advantage of these tax benefits as I'm building my income and my retirement wealth. I am getting tired of the stock market fatigue, the fluctuations, the, as of late, more downturns than upturns, and also finding that it's a new source of capital. If you're already doing some sort of investing and you learn that you can do that same investment with your tax sheltered money, why would you not want to take advantage of that opportunity when the alternative is, again, a more fluctuating stock market or some other assets that you don't necessarily know as well or have as much comfortability in? So the key takeaway points I'd like everyone to get from today's webinar is that there are ways to passively invest in real estate without physically buying a piece of property like 123 Main Street or a commercial property. You can invest as a limited partner into syndication type deals, which is something Badri is going to cover that he talks about in his Avestor network as well, that are ways for you to invest into real estate but not physically have the day-to-day headaches or the maintenance and oversight of managing a piece of property. We always implore you to conduct your due diligence and understand the possibilities of the different options that your investment may take as it pans out through the course of the investment lifetime. And building your portfolio is unique to you. Everyone has a different risk tolerance and a different set of preferred asset classes, and as well as expectations. If you're someone that wants cash flow versus overall growth, those are different things and considerations to have as you're deciding what types of assets you want to invest into, what types of risk profiles you're willing to take with your retirement dollars, and how you want to actually diversify your retirement portfolio into these different asset classes and unique alternative investments. Now, why are IRAs and 401ks a good source of capital? It's really easy to repeat invest. So once you make an investment, it's very easy to redeploy those funds either with the same investment provider, the same group, or in the same capacity at the very least. It's a pretty simple process. Once you do it once or twice, I'm sure you'll be very comfortable and familiar with doing it your third, your fourth time, etc. as you move forward with your investing career. If you're not expecting to use the funds anytime soon, which is often the case with IRA and 401k investors, this is a great way to place your money, have it sitting in an investment, earning great returns, and by the time you're ready to use that later in life when you're ready to retire, those funds in most cases have already been returned, or you're just still yielding cash flow from the investments you've made that you're able to start taking as distributions for living your retirement life. A lot of times you're going to find better returns than your standard stocks, bonds, money market savings, or CDs accounts. And again, you drive those returns by picking what investments and doing the due diligence on the deals you jump into. And then the final thing, why people use these accounts to self-direct, is that there's no outside approval needed. Again, Advanta is not a fiduciary, so you're not coming to us asking, hey, am I allowed to make this investment? Or do you guys think it's a good idea to make this investment? Advanta simply follows what the IRS rules and regulations are and lets you make the investments you want to. You are your own fiduciary with a self-directed account. You, again, have the responsibility of doing your own due diligence, but also have the freedom to make investments you want to into assets that you prefer. It's very important when you're doing self-direction to invest with people you know. That triad you may have heard about of know, like, trust is something very important. So we express a lot of interest in you joining your own investor communities, whether that's your local RIA group, your local meetup group, or finding different things online. Make sure you do some due diligence and invest with people you know and build that know, like, trust triad within your network. And having said that, Advanta does offer a bi-weekly investor networking forum. We call it Pitch, Promote, and Prosper, every other Friday, 12 noon Eastern to about 1 o'clock, depending on the size of the call. We give everyone that signs up for this call a chance to say who they are, either what they're looking for or what they have to offer, and network from there. So check that out. Join us. We will not be live tomorrow. It'll be next week, which, if I'm not mistaken, is February 24th at 12 noon Eastern time. Our education is pretty vast. We have a lot of events in our local areas of Florida, Tampa, Florida, in Atlanta, Georgia, myself located in Western North Carolina. We're always networking in our communities locally, as well as putting on these educational webinars, typically 2 a week, with live guests like Badri that are here to answer your questions and expand your knowledge and understanding of various investment strategies. You can find the recordings of these webinars on our YouTube page. And if you're interested in other industry standard news and information, we have a blog on our website that you can check out, or our podcast, the Alternative Investing Advantage podcast, hosted by my colleague, Alex Burney. A new episode of that podcast drops every week, so check that out if you're interested in those types of things as well. It's really easy to start a self-directed account. Most people can get the application done in about 10 to 15 minutes. Again, it's usually a non-taxable and potentially non-reportable event to get money moved over into a self-directed plan. And a realistic, reasonable expectation is that's going to be about a 1 to 2 week time frame before you're ready to make your first investment. It could be as quick as 7 days. To set a reasonable expectation, I tell most people 10 to 14 is what you want to shoot for as far as an expectation. And then you can invest into, again, anything you want within IRS regulations. We're experts in those regulations, so speak with me, speak with your account manager once you're an active client of Advanta, and talk through the strategies you'd like to pursue. With that being said, I'm going to go ahead and turn it over to Badri. He is going to cover building a diversified real estate portfolio and speak from the side of Avestor and what he's an expert at. Badri, I'm switching over presentation powers right now, and the floor is yours.
Hey, thanks a lot, Corey. Great to be here. Good morning, good afternoon, everyone. I'm not going to put myself in the presentation mode. Can you see my screen?
Badri, right now we can see yourself in your office and also the presentation PowerPoint, not in presentation mode like you said.
Okay, all right. Let's get this baby going. So really do appreciate everyone taking the time to come to this presentation. Hopefully you'll find it useful. Happy to answer any questions. My contact information is at the end. I'm happy to feel free to reach out to me via LinkedIn, email, or even just give me a call, and I'm happy to talk about it. I'm very passionate about this, and just like what Corey is doing at Advanta IRA, we are all about trying to let people build diversified real estate portfolios which span multiple asset classes within real estate. So I want to make sure that should I include my screen here, or is the screen always visible, Corey? The camera?
From my end, the screen is visible with your camera on yourself as well as your presentation. We're seeing the legal stuff slide right now. If anyone from the audience would like to confirm further, just to make sure my role doesn't show a different display, please drop that into the question box. And again, as I said earlier, if you have questions, please drop those there as well so that Badri and I can address them.
Okay, all right. So as I indicated, as Corey indicated, nothing we say in this presentation should be construed as official recommendations to buy or sell securities. Real estate definitely has a certain amount of risk. I'll let you go ahead and read the disclaimers which we have to put. Avestor is not a registered broker-dealer or a registered investment advisor. Not all real estate investments are suitable for everyone. You have to do your own due diligence or conduct your own investigation or talk to your own investment advisor. Yeah. So having said that, let's get to the meat of the presentation. So many of you have built a stock portfolio, no problem, right? I mean, there is so much literature out there on how to build stock portfolios of different types of segments and stocks. Building a bond portfolio is still not a great problem. I mean, you can have intermediate bonds, long-term bonds, and muni bonds. But building a real estate portfolio, where do you start? I mean, we are not all we are not all Bill Gates of the world, unless you have billions of dollars to invest in multiple asset classes and multiple geographies. How do you go about building a diversified real estate portfolio? That's kind of what I would like to talk to you about. It's quite hard, right? What we are trying to encourage you to do, just like Corey is saying, and move today, the vast majority of the American public are completely invested in stocks and bonds. And frankly, Wall Street has done a number on you, right? I mean, saying that's the only alternative out there, which is in their interest. You want to try and diversify away into that, into other alternative investments. In this particular presentation, we'll talk about real estate being a slice of your portfolio. And obviously, there are all kinds of other alternative investments out there. It's quite difficult. How do you find the opportunities? There are all these complex deal structures. Each deal has significant capital requirements. Then you have to manage the risks associated with each deal. And like any investment, you haven't made money until you have made money, until you actually exit the deal. You can sit in all the paper gains you want, but until you actually close the deal and you have exited the deal, you don't know what your actual returns are. And real estate, as you know, is a little less liquid. So how do you know when to exit and what's your exit strategy and so on, right? So basically, what I'm going to talk about today is I'll talk about the different types of real estate deals which are available out there. I will talk about some of the top portfolio considerations you should take into account when you're building a real estate portfolio. What type of criteria should you be using? I'll talk a little bit about how to use crowdfunding to accelerate your portfolio. And then finally, we'll briefly talk about Avesta, a platform for building real estate portfolios, and actually non-real estate investments as well, but we'll focus on real estate for the purposes of this talk, yeah? So what are the different ways you can invest in real estate? The most common, I mean, you buy a house to start with. I mean, maybe you don't consider that as an investment, that's a place to stay, or you can buy individual houses. You can invest in something called syndication deals. While there could be an entire talk on that by itself, I will give a brief introduction to syndication deals. Many of you may already be familiar with syndication deals. You can buy shares in private real estate investment trusts or funds, or publicly traded real estate investment funds. Or you can also invest in real estate loans, where you're investing in either an entire loan, you're lending it to somebody who's doing a fix and flip, or you're investing in fractionalized loans. We'll talk about all of that, yeah? The most common scenario is buying a direct property, right? It could be a second home, or it could be a small multifamily 2 to 4 units. Maybe you're putting 25% down, taking 75% loan from the bank. Many of you, even if you have not done it, I'm sure are familiar with this concept. The main, you'll have to manage the property yourself or get a property manager, and you buy the property when you want, and if you have control over the property, you decide to exit when you want. The main advantage of this is you have complete control over the asset, and the investor makes all the decisions. In some sense, people might have already told you this, right? The renter is paying off your mortgage. That's a good situation to be in, as long as you have good renters. But here, there are some disadvantages, right? You do have to put significant cash down, and you have to manage the renters, the famous toilet clogging at the midnight situation. Yes, you could get a property manager, but then that's additional cost. There is not much liquidity. I mean, until you decide to sell the house, and selling and buying real estate, entire properties is not that simple. It does take time. And more importantly, you're not diversified. A lot of people make the mistake of buying their second home very close to their first home or in the same geography. And then you're subject to the same market risk, right? If a particular geography goes down, now you're putting all your eggs in one basket, right? So alternately, you can also buy private real estate investment trusts or public real estate investment trusts. So public REITs are traded in the stock market. Examples like Simon Property Group or Public Storage. The biggest advantages are they're very highly liquid, easy to research. It's almost like buying a stock, but there are some significant disadvantages. You really don't know what you're buying exactly. There is, you have to read the fine print. Yes, there are 500 properties and you get a slice of it. You don't get to choose which properties you want to invest in. When you invest in a REIT, you cannot go in and say, I want to invest in property A, B, and C, but I don't want D, E, and F. You cannot do that. And more importantly, public REITs are very much tied to the stock market. The whole point of alternative investment is to move away from the zigs and zags of the stock market, and you can't do that with a public REIT, So, whereas in a private REIT, it's available through brokers or directly. They're generally exempt from SEC registration. There is a little more transparency on the investments. Kind of know a little more about what you're getting into. You're able to get into deals which are not available in a public REIT, and a lot of the tax benefits flow through because of the LP tax structure, the depreciation benefits. You don't get many of the depreciation benefits in a public REIT. Or even if you do, it's indirect. Some cons: there is still fairly limited liquidity, not as liquid as a public REIT, and requires a fair amount of investor research, not only on the individual REIT, but the sponsor behind it, right? So. And then another opportunity to invest in real estate is real estate loans. These are small to medium-sized loans, and typically the borrower, for various reasons, may not have access to capital from the banks, and so is looking for alternative sources to raise investments. The notes may have a first lien on the property, or sometimes it may be a second lien. It depends on your level of risk. I recommend you go only with loans which have the first lien on the property. But if you do want high returns, you can buy loans which have second liens on the property. So you're second in line. The bank or the person who has the first lien on the property first gets their money back before you get your money back. The main advantages of this are these are short-term investments, 2 to 24 months. Typically, they were been paying 6 to 11%, but recently, since interest rates have gone up, now you get almost 12, 14% sometimes. Pretty good returns, even compared to what you're getting in the bank. The bank returns have gone up too. Great passive type of income. And you really do want to invest in loans where the borrower has put at least 15 to 20% down. You want to stay away from loans where the borrower has very little skin in the game, because then he can walk away. Some of the disadvantages are the borrowers may have limited track record and history, and there's a reason why the bank is not giving to them directly. And another disadvantage is, unlike investing in syndication deals, where any capital gains, you get the long-term tax benefits, any income you get is completely considered regular income, and you have to pay regular income taxes on it. Yeah. And be careful, sometimes you don't want to go into loans where the foreclosure process can take a while, where renters have a lot of right. You want to go into landlord friendly states and not rental friendly states. Yeah. So another opportunity for you to invest in real estate is syndication deals. Maybe I don't know if you can do a quick poll, Corey. I don't know how many of the audience members are familiar with syndication deals. Maybe you can do a quick poll and tell me the results, if that's something I don't know if you can do or not.
Yeah, so, Badri, I will. I'll try to do that. Or if those of you participating want to add a question into the question box, just to say, hey, I've done a syndication or not, feel free to do that, audience, while I try to set up a poll real quick. Badri, before you jump into the next thing, as I looked up at my screen, there was a question that just came in a second ago.
Please.
I am selling office building in Clearwater, Florida, and want to reinvest with 1031 tax-free exchange. Do you do this?
So when I say, do I do that, I'm assuming you're talking about Avestor. Avestor is a fund of funds platform. We'll talk about it. Maybe I'll come back to this question at the end. And when you're investing in another fund, it does not support 1031 exchange. It's not a platform limitation, but IRS does not allow you to take a property and invest in another fund, a fund of funds, where you can build a diversified portfolio. But you can certainly do 1031 exchange through the normal scenarios where you identify another property. So maybe not quite the answer you're looking for. It's not so much a limitation on our part, but IRS doesn't allow you to invest in a fund of funds. Avestor is a fund of funds model, and I'll talk a little more about that at the end of the presentation. So.
Yeah, I think that makes sense. That answer clarifies for that individual. Just in the moment, we had two responses. One person said they have no syndication experience. The other person said that they do have syndication experience. So at least as of right now, with the responses I've received so far, it's we're split 50-50.
All right, sounds good. So what are syndication deals? Why don't we go through it a little bit? Syndication deals are typically large commercial real estate deals like multifamily, student housing, retail, industrial, hospitality, hotels, offices. It can either be a new construction or a value add construction. A new construction is where, it's obvious, you're building it from scratch, and a value add is you're taking an existing apartment and renovating it. Syndication deals allow you as a relatively small investor. I'm assuming there are not people here with hundreds of millions of dollars to invest. They probably go to different type of presentations. And the syndication deals allow you to invest as little as $10, $20, or even $50,000 into these apartment complexes and commercial complexes. Generally, the way it's structured, it's a limited partnership. You become a limited partner in the deal. There is a sponsor who's leading the project, and he is the general partner. Investors provide, you as the investor provide the capital, and the sponsor runs the project, does the, either does the project management, portfolio management himself, or he may give it out to a property manager, and you split in the profits. The rent comes in, and it's a 70-30 split or a 60-40 split. We'll talk a little more about that. Some basic terminology. I'm not going to spend too much time on this because I do understand the presentation is available for you offline to look at as well. Internal rate of return, which is similar to compound interest, where it's basically what is the return over a period of time, and it's only an estimate, not a guarantee. Cash on cash return. It's like if you invest $10,000 and you're getting $5,000. Let's say you invest 100,000 and you're getting 5,000 every year. The return you're getting on your cash is the cash on cash return. Equity multiple is basically a scenario where is a term which is used to indicate how much money you're getting back over the lifetime of the project, right? Yeah, if you're investing $100,000 and you get 200,000 after 5 years, the equity multiple is 2. You're doubling your money. Preferred return is a concept. You should be familiar with this terminology when you when you evaluate syndication deals. Is the concept where when rents come in from the property, a certain percentage of the property. A certain percentage is first given to passive investors before the rest is split between the sponsor and the passive investor. So you can say if it's a 7% preferred return, they're just basically saying that the first 7% goes to investors, and then it's split between the passive investor and the GP. Yeah. Debt service coverage ratio is you obviously want to make enough money to pay off your debt at least. That's the bare minimum. But typically, you really should be looking at 1.5 or higher debt service ratio, which is the net operating income divided by the debt payments. Yeah. So the typical financial structure is as follows. The sponsor still takes a loan, and the investors give some equity, and the sponsors also put some equity in. Let's say it's a $10 million property. Maybe $8 million is a loan. The investors put $1.5 million, and the sponsors put $500,000 in equity. And when the property is sold, the very first person who gets paid back is the principal of the person who's given the loan, the bank or whoever. And then the interest for the lender is paid back. Then the preferred equity for the investors is paid back, and then the sponsor and investors split their profit. Yeah. So generally, there may be 1 or 2 tiers. So for example, the preferred equity, the first year might be the preferred equity where the first 8% goes to the investors. And then any return above that to, let's say 15% is a 70-30 split, and any a return above that is a 60-40 split. So you can have different splits on how it is divided between the sponsor and the investor. If you'd like to learn more about this, at Investor, we have a great blog which talks about how to, what are the syndication deals 101, and the link is there in the presentation, which I'm sure you can download afterwards. Yeah. So what are some of the pros and cons of syndication deals? The biggest pro is an opportunity for you to participate in deals, which honestly, most of us cannot even dream of, right? Can I imagine going and buying a 300-unit apartment complex in Texas or something? Probably not. Not all of us can do that on our own, buying it completely. And you get much higher returns than what you would get in a typical real estate loan, or generally a well-constructed syndication deal can give you higher returns and better tax benefits than what you would typically make in the stock market. 15 to 25% annualized returns. You'll have to excuse me, I'm fighting a little bit of a cough here and cold, but I'll power through this presentation. Another big advantage is that you get all the tax benefits which are similar to owning a real estate directly. So you get all the depreciation benefits. Some disadvantages are you do need to put, well, you don't have to put the millions of dollars required to buy the apartment, but you do need to put $20,000 to $50,000 to $25,000 to $50,000. There is no liquidity. Generally, once you invest in this deal, you have to wait for 3 to 5 years, and you don't really have any control over any decision making. The GP has full decision making capability, and the first lien lender will always get first rights to any profits or any results which come in when you sell the property. And if you're not careful in picking the right type of deal, you could result in full loss of investor capital. That's like any other investment, right? So here are the top misconceptions of syndication deals. Again, if you go to this blog article, we go into a lot more detail about it. Passive income, a lot of people might tell you that passive income is guaranteed. It is not. That's the goal. It really depends on the deal. You want to make sure there is enough cash flow. And the target returns are not annual. The way syndication deals work, you may get a small percentage of it upfront annually, but a lot of the money comes in when the deal exits. And hopefully the deal exits in the market time, when the market timing is right. And deals don't always exit on time. Don't be misled by fancy presentations. People spend a lot of money, go to a great graphic designer and have these fancy presentations. You do need to do your due diligence. And syndication deals are not low risk, though some are a lot lower risk than others. Yeah. So let me pause here and see if you have any questions before I talk about the top portfolio considerations for building a real estate portfolio. What are the types of criteria you should look at? What are the factors you should be evaluating? And but let me pause here. This was a quick overview of the different types of real estate investments you can do. Hopefully you're not familiar with all of them, and some of it was new information.
Badri, while we're pausing there, I'm going to go ahead. I was able to create a poll. I think I accidentally put it up on the screen earlier for a brief second, but I'm going to share that right now so we can see if we can get more feedback on that poll. I ask everyone, as Badri just said, to go ahead and jot your questions down in the question box. And a quick additional note that I'd like to make, as Badri said, the presentation deck from today's webinar is available to you. You can either reach out to Badri directly if you have questions or want to ask him things from his side, reach out to me directly. And I've also used a feature in GoToWebinar in the handouts portal. You'll see a PDF version of today's presentation there. So you could download it through handouts or reach out to either Badri or myself directly if you'd like a copy of today's presentation deck. Looking back at the question box, someone that said they have not known it as a syndication, but they have invested in these split ownership deals. No other questions at this moment have come in. And it looks like I haven't gotten any syndication quick poll results. If anyone could just confirm if that quick poll is up on your screen. I've got just 3 different options for you to answer from there. Are you familiar with the syndication? Yes, I've been a syndication investor. No, but I want to learn. And yes, I've used my retirement funds to invest.
Okay, great. Why don't we keep chugging along? I think we are running towards the end, and maybe you can share the results later on, Corey. So what are the top portfolio considerations you should be looking at? You have to look at the structure of the portfolio. You want to make sure it's diversified. You want to look at the criteria for selecting a deal. You want to ensure you have adequate cash flow. You want to ensure you have multiple liquidity points, and you want to ensure you're maximizing tax benefits. Okay, this seems obvious. How do you go about it? Let's go into a little more detail here. What do I mean by the portfolio structure? Let's say that, I don't know, we'll make up a number. You have $1 million to invest. No, let's keep it a smaller number. Let's say you have $200,000 to invest, right? A little more reasonable. How do you divide it up? You could buy 2 single-family houses at paying $100,000 cash each and take the rest loan, or you could buy 4 private funds at $50K each, and or you could buy 8 syndication deals at $25K each, or you could buy maybe 40 commercial or loans at $5,000 each, right? I mean, so what I mean by the portfolio structure is you need to transition from, okay, which property am I going to buy, as to a question of how am I going to divide up this portfolio. I'm not saying you have to think of every single step you're going to take, but you do. This is like a jigsaw puzzle. Think of where you want to be 5-10 years from now and start putting the first piece of the puzzle together. How much of it do I want in direct investments? How much of it do I want in syndication deals? How much of it do I want in loans, right? And you want to ensure you're diversified across all markets. You might say, what? I have just $100,000. How am I going to do it? There are ways you can do it, and I'll talk a little bit about that, because markets have different zig and zag cycles, right? Some markets go up at different times, and you want to ensure diversification. Just like a stock portfolio, geographic distribution is very critical. You want diversification across asset classes. You want to do, obviously, both new construction and value add. Typically, the rule of thumb is new construction is higher risk for obvious reasons. You don't get any cash flow until the project is completed, but they have higher returns too. New construction could be multifamily, single family, retail, built to rent. Built to rent communities are communities which are built just for renting. And value add also are similar asset classes, but where people may take an existing property and then renovate it and try to get better rents. You again want to do a mixture of both. And the multifamily asset class is one of the most traditionally considered safe asset class. If you want to start with real estate, a multifamily is a good asset class to start with. The big advantage is there is good cash flow. People need a place to live in. I mean, it doesn't matter what the economy is doing. You got a place to live in, right? Be careful. Sometimes sponsors overestimate the rent they're getting, and be prepared to be invested for at least 5 to 7 years in a multifamily asset class. Yeah. So student housing asset class is also a pretty good asset class. The reason is, again, it's a captive audience, right? I mean, if you go to particularly well-established universities, as opposed to the third-tier universities who are struggling to get students sometimes, you get relatively low risk, and but there is more turnover, and students are very budget conscious. So ensure that the project is not, is appropriate for that particular university, right? So the point there is you do want to invest in multiple asset classes. I do not have the time to go into all the individual asset classes. I just picked a couple of key asset classes, and you want to mix between value add and new construction. Yeah. So, and then you have to select the deals. You have to look at in single property risk, you look at the renter risk, look at the debt servicing risk. Is there enough money to pay back the debt? Then you look at the details of the property steps, property specifics. In real estate loans, it's a superset of that. You want to ensure you invest in states where there is foreclosure flexibility. You want to ensure that you're giving money to people with a strong track record. And I'll tell you a little bit about how you do all of this. And in addition to that, in syndication deals, you have to look at the capital stack. What type of splits are you getting? A 70-30 split, a 80-20 split? You look at the overall deal structure, and then you also look at the track record of the sponsor, right? So research every deal thoroughly to minimize risk. And then you also need to look at the cash flow you're getting from your real estate portfolio. People often don't spend enough time on that. If you purchase a rental property, that's pretty typical, right? You put some principal in, and then you get some monthly income, you have some loan expenses, and then hopefully at the end of the day, there is a pot of gold waiting for you when you sell it out. In a debt deal, typically you get monthly interest every month, and then you get your principal return, or sometimes the interest is accrued. In an equity deal, especially new construction, there is very limited or no distributions in early years. Most of the distributions come in later years, and then finally you get your principal return and appreciation. Yeah. So another point to look at is portfolio liquidity. It is very, very important that you take this into account, even if you feel like you don't need to be liquid. You know, life can throw a curve at you. You want to design a portfolio with multiple liquidity points. And if you take advantage of all the different venues which I had mentioned, you can do that. I mean, all real estate doesn't have to be completely illiquid. If you build laddered portfolios, some loans maturing in 1 year, some loans maturing in 2 years, some syndication deals which are 3 years, some syndication deals which are 5 or 7 years, right? So a well-built portfolio gives you multiple points of liquidity, right? So, and then take into account the tax calculations, tax implications, right? The real estate loans, typically you get a 1099, and like I said, it's regular income and you have to pay regular income taxes. There are syndication deals where you get a K1 for each equity investment. It's called a partnership return. Most TurboTax or all your, obviously any CPA would handle your tax returns for you, but you can also use popular filing programs. And typically a private REIT or fund will give you a 1099 div. Be aware that if you invest a significant amount in an equity investment, you may have to file a tax return in that state. So you want to take that into account before you do really big investments in states which have a high income tax. If you're already in a state with a high income tax and invest in a state like Texas, there's no problem because there's no income tax there to start with, right? So.
Just to add real quick, I'm sorry, Badri, just to add real quick, these tax implications may not apply when you're doing these investments with your retirement dollars. Correct. So that in itself is a separate consideration. If you're here to learn more about the retirement account side of things, that may not necessarily apply, but still it is important and valuable to be aware of. You could speak to me directly if you have questions as it relates to these strategies and actually using retirement dollars.
Excellent point. And that's one of the advantages of using retirement dollars, right? So you don't have to worry about it. It goes tax-free, and you don't have to worry about filing these tax returns in other states and things like that. Yeah. So
exactly. Yep. Sorry, I didn't mean to cut you off.
No, that's that note. Point. Yeah. So one last thing before I move to the next topic, you do get independent K1s, and you can combine all of that. Passive losses from one investment can offset gains from another investment. So as long as one of these strategies, which a lot of people use, is continuously invest in syndication deals every year, and sometimes in a syndication deal, you get something called the accelerated depreciation, where you get more depreciation benefits in the first year. That's a big plus, and you can continuously offset depreciation and capital gains, so you can more or less indefinitely postpone your tax burden. Obviously, that's not an issue if you're looking at a retirement account. Yeah. So one last topic before I move to talking a little bit about how Investor can help you build a customized diversified portfolio. There are real estate crowdfunding platforms. What is a crowdfunding platform? At the uncanny risk of I call this the uncanny risk of the obvious, a crowdfunding platform is where you're funding money from a crowd, right? I mean, I know that sounds obvious. These are online marketplaces where investors can invest in large real estate deals. You can participate in larger projects, And these are all passive investments, and this will, unlike having to find a project yourself and a property yourself, this allows you massive amounts of asset class diversification and geographic diversification. Some points which you should be aware of: there are many crowdfunding platforms out there, but remember, think of them as a seller's agent in real estate, if you're familiar with that term. They're really not representing you, the buyer, though they're providing you a service. They're really representing the seller, right? I mean, they want to put the seller's deal in the best format. They want to raise money for, who is the seller? The person, the sponsor who's raising money for the project, right? Make sure you read the PPMs. The partnership details can change quite a bit, and don't always go by advertised returns. Look at the worst case scenarios, and it's very common for deals to take longer than anticipated. So there are 4 categories of crowdfunding platforms. There are platforms where you can buy complete properties. I know you can obviously buy a rental home close to your house, but how do you buy a rental home in another state? There are websites like roofstock.com and various other websites where they not only help you find a property, but they take care of the management and everything else. Or you can invest in syndication deals, right? I mean, there are companies like CrowdStreet, some of you may have heard of, where there are hundreds of syndication deals, and Avestor too, actually. We'll talk about that. A platform like Avestor can help you diversify into multiple commercial properties with a single investment. Or you can invest in multiple debt loans, and there are platforms like Ground Floor, Fund That Flip, where you can invest as little as $10 in a real estate loan. I mean, obviously, it's not worth your while to put $10, but I'm saying it really doesn't require a high capital to get started. So let me go ahead and talk about Avestor, and then we'll take questions at the end of the presentation. So what is Avestor? I'm a co-founder of Avestor. We want to bring alternative investments and real estate investing and make it as easy as investing in a stock portfolio. It's quite, as you can see, it's quite complicated to invest in, build a real estate portfolio. We want to make that as easy as building a stock portfolio. So it's an online platform where investors can partner with experts to build custom real estate portfolios. We are not trying to sell you a blind fund where you have to invest in every single deal. We have more than 60 funds on our platform. Not all the funds are shown. If you are welcome to go to avestorinc.com. It's there in my email address at the end, and the website is at the end of this presentation too. We have more than 60 customizable funds. The key word here is customizable. How does it work? We have various fund managers, some of them very, very experienced. The fund managers identify the investments and identifies investments, and then these investments are fractionalized. Think of it like the wholesale retail model. Costco, okay, they go buy a bunch of stuff and they put it up in the shelf, and you as an investor would join the fund, and then you can go and pick and choose which deals you want and how much you want to invest, and which asset classes you want to invest. You can say, I want to put $10,000 in this new construction. I want to put $5,000 in this value add apartment in Texas. These fund managers will actually advise you based on your life situation. You may have a kid going to college, I don't know, in 5 years, or you may want more cash flow than capital gains, or you might be in a high income tax bracket already, and you may want to defer all your capital gains to a later stage. And so you get to pick and choose deals just like you would pick an individual stock portfolio, and you build custom portfolios. You can actually build 60-40 portfolios, 70-30 portfolios, if you know what I mean. Like if you go to an investment advisor, they say 60% stocks, 40% bonds. You can do that here. 60% syndication deals, 40% debt deals. And when the nice thing about this fund model is when earnings come in, you can reinvest. You can, just like you reinvest a dividend reinvestment in a stock, you can either reinvest, or when a deal exits, you can withdraw the money. And all the funds have, our platform provides ACH integration. So if you want to withdraw the money, you can withdraw it with a single click, or you can reinvest money in new deals. Yeah. So what are some of the main benefits? The fund manager does all the deal selection and research. Instead of you having to look at 100 deals, And then the fund manager may look at the 200 deals and select 5 deals, and then you get to pick and choose in that 5 deals based on your life situation, right? You build custom portfolios, you get diversification across multiple states, multiple time horizons. Remember the portfolio consideration I was talking about. You want multiple liquidity points, and some deals maturing in 1 year, some deals maturing in 3 years, some deals maturing in 5 years. You want multiple asset classes. You want student housing, you want retail, you want hospitality, you want multifamily. I'm not saying you'll get into all of that in day one, but you can build a diversified portfolio with as little as $25,000 or $50,000. And it's very, very transparent. What do I mean by that? When you go into this large scale blind funds, you really don't know what you're investing in. You're getting a slice of pie and based on how much you invest, and you have no idea what are inside that pie, you know. Whereas here, we have this really streamlined portal where you can log in and you'll see how each individual investment is doing, as opposed to how just the overall fund is doing. And you have multiple points of liquidity where you can withdraw the money because you're not investing in one deal, but you're investing in 10, 20 different deals. And the best part is all of this is packaged in one single simple LP structure. Remember the K1s I was talking about? Instead of getting 10 different documents from 10 different providers, our platform generates one K1. So it makes it so much easier to do your taxes. So here is a portfolio example. See, I noticed that for as little as $25,000, this person is invested in multiple states. He's investing in multiple horizons, 3-year time frame, 3 to 5 year time frame, and 5+ year time frame. If you look at it, he's put as little as $500 in this loan. It's a single family home purchase, 7.5%. Another $500 in this 11% loan, which is in Rochester, New York. And then he's put some money in a couple of syndication deals. This is not a hypothetical example. This is real. For as little as $25,000, you can put in 10 different investments across multiple states, multiple time horizons, and multiple asset classes, single and multifamily, student housing, apartment complex, retail, office space, and so on. Yeah. So typically you do both. We already talked about this. The kind of deals available in these funds are the syndication deals and real estate loans. You can build custom portfolios. Maybe if you need more cash flow and you don't mind paying the higher taxes on real estate loans, which I told you is like regular interest, you put more in real estate loans and put less in syndication deals. But you can build 60-40, 70-30, whatever portfolios. And you can even pick relatively lower risk categories like multifamily, student housing, and self-storage. Self-storage is I didn't get into a lot of detail in that, but it's a great asset class, which does well even in times of recession, because once people, you know, put their stuff in storage, even if you increase the rents by $5-10, they're not going to remove it that easily. Yeah. So we have a complete online portal. Like I said, I won't go into the detailed demo right now, but you can. I don't know if you're able to see, but you can see the account balance, the number of deals, return on deals which have exited. You get a detailed breakdown of every single investment you have done, just like a stock brokerage account. And this is a custom portfolio which you're building. And then this is like a vanity map, which shows you how your deals are distributed across the country. You can click on anything to get more information. And that's kind of what Avesta does. We make it very, very easy for you to build custom real estate portfolios, which take into account all the different considerations which I was talking about: diversification across asset classes, diversification across geographies, multiple liquidity points, and carefully screened deals, and complete tax benefits. And it's not 1 or 2 funds. We have 60 funds on the platform. We think we'll have more than 100 funds. Advanta is one of our preferred partners. You can go through Advanta and still invest in one of these funds. And I will conclude there with my full contact information. Feel free to send me an email, or I've even taken the liberty of including my mobile number. Feel free to give me a call if you even just want to talk about just general real estate investing. And I've also given my LinkedIn address as well. Again, thank you, Corey. And I think we have a few minutes for questions, a little longer than I wanted to go, but I think we did take some questions along the way. So
no, I think we're really great on time, actually, Badri. Thank you so much for your presentation here. And just to reiterate there, whether you are a investor that may be interested in looking into one of the 60 and growing funds that Badri currently has available at the Avestor site and through their platform, or you are a investment provider as well and looking to maybe set up your portfolio with Avestor, reach out to Badri and he'll be able to help you either way, whichever side of the table you're on there. This is a really great platform that really could improve your ability to reach investors or make your investments in a diversified capacity. So I definitely implore you to check that out, look into it further, reach out to Badri directly. And again, we've got just about 2 or 3 minutes. If anyone has any final questions they'd like to ask, please drop those in the chat as we're wrapping up, and we'll be able to address those here in the closing minutes of today's webinar. Thank you again, Badri. I know we've had you on in the past, and you've covered great content for us, and we really do appreciate that and look forward to having you on again in the future and keep things growing and our partnership and relationship growing as well.
Thank you, Corey. Value our partnership with Advanta. So, yeah, I just want to reiterate what Corey said very quickly. This has been an investor-oriented presentation, but we are actually a provider for people, syndicators, to build their own customizable fund, which give all the benefits which I described to the investor. So if you are a syndicator yourself, I don't think there are a lot of you in that audience, or if you want to build your own fund and build your own investor base, please do reach out.
And I'm not seeing any questions come in at this time. We are right at closing time. So I'm gonna go ahead and wrap us up. If you do have anything that you'd like to ask myself or Badri, please reach out to us directly. As I mentioned earlier and Badri referenced, you can have access to the full slide deck if you'd like. Just reach out to either of us, or before you sign out here, check the handouts tab on GoToWebinar. I've dropped the PDF of the slide deck there. We're more than happy to answer any additional questions you have. So we will wrap it up. Again, thank you, Badri. I hope everyone had learned something from this presentation and can walk away with a better understanding of A, self-direction, B, a few different asset classes that we went over, and C, how Avestor makes it easy for you to tap into those asset classes or offer them if you are a syndicator or investment provider yourself. Thank you all. We look forward to seeing you next time, and have a great day.
Hey, thank you, Corey. Thanks, everyone. I look forward to hearing from you offline.